In my last video, I showed you why VOO by itself isn't a complete portfolio. So in this video, I'm going to show you some great international complements to VOO and some not so great complements. I'm Kyle, and I used to help portfolio managers who managed hundreds of millions of dollars, or sometimes billions, build portfolios. For international complements to VOO, I'm going to cover my top options in 4 broad categories: passive, high dividend, low volatility, and active, capping it off with my overall winner at the end. Of course, nothing in this video should be considered an investment recommendation because obviously I don't know your individual circumstances, but hopefully this will help you learn how to evaluate funds and make better investment decisions on your own. Let's dive in and start with my favorite passive options. First, so I don't leave you wondering, I'll start with 2 popular ones that I would personally avoid: EFA, the iShares MSCI EFA ETF, and ACWX, the iShares MSCI ACWI ex-US ETF. I'd avoid these because there are much cheaper alternatives that are almost identical. Basically, you're paying up for the licensing rights to the most popular indexes, and you're paying a premium for high liquidity. Well, if you're moving tens of millions of dollars around daily, that might matter. But if you're an everyday investor, those things probably don't have a lot of value to you. Let's start with EFA alternatives. EFA tracks the MSCI EFA index, which covers international large and mid-cap stocks, except for emerging markets and Canada. Instead of paying 33 basis points for EFA, you could pay 7 basis points and get literally the exact same thing, except also including around a 10 to 15% position in small caps by going with IEFA, iShares Core MSCI EFA ETF. In my opinion, for a lot of investors, it's actually a net benefit to have the small caps in there because it gives you even more complete exposure, and small caps are generally considered to be a higher risk reward part of the market than large caps. But even better than that, another version that's the same thing but with Canada included is IDEV, the iShares Core MSCI International Developed Markets ETF, and that only cost 4 basis points. 2 quick side notes. First, at the end of this video, I'm going to put up a diagram with all the key differences between these ETFs next to each other, so they're easy to compare. And second, for anyone who isn't familiar with this term that I'll be using a lot, a basis point is 1/100th of a percent, or 0.01%. So a 7 basis point fee means that each year the cost to own the ETF is 0.07%, or 70 cents for every $1,000 you have invested. So saving a few basis points doesn't really mean much on $1,000 in 1 year, but over time, with larger dollar amounts, it can definitely add up. And since they're almost the exact same thing, why pay extra? 2 more runner-up alternatives to EFA that don't invest in emerging markets are SCHF, the Schwab International Equity ETF, which costs 6 basis points, and VEA, the Vanguard FTSE Developed Markets ETF, which cost 5 basis points. The main difference between them is that VEA includes small caps and SCHF doesn't. These are all fine in my opinion, and the differences are fairly minor, but if I had to pick a winner among passive developed markets international ETFs, it would be SPDW, the Spider Portfolio Developed World ex-US ETF. It's the winner because it's the cheapest at just 3 basis points, and I like that it gives more complete exposure by including small caps. This ETF and all the FTSE ones also include Canada and South Korea, by the way, which EFA does not. However, if you're just looking for one ETF to represent all of your international exposure, in my opinion, it's not complete without including emerging markets. After all, they're the fastest growing part of the international equity universe with the most risk, but also the most long-term upside potential. For that, here are my top alternatives to the 34 basis point ACWX, the iShares MSCI ACWI ex-US ETF. In third place, we have VEU, the Vanguard FTSE All-World ex-US ETF, which costs 7 basis points. This is tied for the cheapest one, but it's in third place because it doesn't include small caps, and the top 2 options do. In second place, we have VXUS, the Vanguard Total International Stock Market Index, which comes in at 8 basis points and includes about the most complete exposure to international equities that you can get, with developed and emerging market stocks and small, mid, and large cap stocks. But Kyle, is there an option out there that has small caps and is the cheapest? Well, you've got one with our winner, IXUS, the iShares Core MSCI Total International Stock ETF, which also comes in at 7 basis points. Obviously, these are all really close and all totally fine to own in my opinion. But All else equal, I'd rather save a basis point if I'm getting essentially the same thing. And all else equal, I prefer small caps to be included for the same reason I prefer emerging markets to be included. That's where the highest long-term upside potential is. Thus, if I had to pick a passive international ETF, it would be IXUS. However, I would actually never buy a passive international ETF. Why? Because it's much easier for active managers to beat passive outside the United States. Active managers try to beat the market by gaining an information advantage. Pretty much everyone knows what's going on at Microsoft and Amazon. But when you get outside the US, and especially into emerging markets and small cap stocks, the companies are a lot less well known. That gives the few people that do know them really well an advantage. Why do you think those SPIVA active versus passive studies usually only include US mutual funds? S&P creates them, and they make money by licensing out their index holdings to passive fund managers that want to track their indexes. If they include international or bonds, passive won't look as good, and they won't make as much money. As of March 31st, 2024, almost all those ETFs I just talked about have consistently trailed their average active peer over the past 1, 3, 5, 10, and 15-year periods. Here's IXUS, for example. What these percentile rank numbers mean is that IXUS is in the top 57% of its peers over the last year, 72% over 3 years, 4% over 5 years, and 57% over 10 years. Or put differently, it has trailed 57% of its peers over the past 10 years, which includes both active and passive. You can go to Morningstar.com and easily look this up for any mutual fund or ETF. The ones that don't invest in emerging markets have done a little better than average because emerging markets have done poorly since 2010. But against active funds that also don't invest in emerging markets, they've generally trailed. So if you just want to save a couple basis points, go for it. More power to you. But I see investing as perpetually uncertain. It's about gauging and managing risk reward and giving yourself the best possible odds to achieve your objectives. My objective is to maximize my long-term returns. And there are some active managers out there that I believe give me a better chance to do that than their passive alternatives. So you think I'm crazy, right? Well, you might want to wait until the end of this video before you pass judgment. What I'm going to show you is going to blow your mind. But before we get to my top overall international ETF, let's cover a few that are tailored to high income and lower volatility objectives. We'll start with two options focused on low volatility. The more popular option is EFAV, the iShares MSCI EFA Minimum Volatility Factor ETF. I have mixed feelings about this one. On the positive side, it's pretty cheap at 22 basis points, and it has a solid process. It starts with the MSCI EFA index, the same one that EFA tracks. But it uses a computer-driven model to build a lower volatility version of it. Smartly, it considers both the volatility and estimated volatility of each stock, and how each of them correlate with each other, which is an important factor that contributes to the volatility of the overall portfolio. Lower correlation equals lower volatility, all else equal. What I'm not a huge fan of is that it limits the amount that country, sector, and holdings weights can differ from the MSCI EFA index. Obviously, you don't want to have the portfolio all in one sector, or that introduces unnecessary risks. But the MSCI EFA is not constructed for low volatility, so trying to stay close to it can lead to suboptimal results, in my opinion. There are certainly people who would disagree with me on that, but I think there's a better way to go about it, which you'll see in the next ETF that I cover. I like that it has a solid long-term track record, but it hasn't done as well in recent downturns as earlier ones, and lately, it's given up more of the upside than it's protected on the downside, which is concerning. You can see in this table that it held up really well in 2014, 2015, and 2018, but not that well in 2022. It only beat the average international fund in its category by less than 1%. In the downturn of 2020, it beat the MSCI EFA by over 5%. But for the full year, it ended up trailing by more than 10%. In the up years, as should be expected, it's been terrible. Honestly, I've racked my brain and I can't seem to make sense of why it did so poorly in 2022. You can't discount its solid long-term track record, even with 2022 included, and I think its process is relatively well designed to limit volatility, but I think buyers should just be cognizant that it may protect on the downside much better in some downturns than others. Our winner in the low volatility category, which is also a competitor in the high dividend category, is LVHI, the the Franklin International Low Volatility High Dividend Index ETF. It's a little more expensive at 40 basis points, but still very cheap and worth it in my opinion. At its most basic level, it looks for stocks that have high dividends and not only low volatility of price, but also low volatility of earnings. The earnings piece is important to me because it can be predictive of future volatility, sometimes better than simply looking at what the price has done in the recent past. They also don't just look for companies that pay high dividends, like a lot of dividend ETFs, but companies that are likely to pay sustainable dividends. Sometimes the stock prices of high dividend paying companies gets crushed when they have to cut them, which obviously leads to lower dividends and bigger losses. So the sustainability of the dividends is important. Unlike EFA, it includes Canada and small caps. So it has a bigger pool of stocks to pick from. And unlike EFAV, it just limits the concentration of the index. So there's not too much in any one sector, country, region, or company. Rather than trying to stay close to an index that's not optimized for low volatility or high income. In my opinion, this is a better way to go about it. Another key factor that helps it limit its volatility is that it hedges its currency exposure. We'll come back to that in a second. So how has LVHI done? The short answer is way better than EFAV. It has a higher yield, about 5% versus about 3%. It's had lower volatility over the past 3 years, 5 years, and since its inception in 2016. And it's had more than triple the return since its inception. So why did I even cover EFAV in the first place? Well, besides the fact that it's by far more popular, here's one more important thing to consider. The fact that Franklin hedges its currency is not only key to helping it lower its volatility, but it has also boosted its trailing results since the dollar has been strengthening so much. It still would have crushed EFAV without that, but it's an important factor to consider because while it should always help lower volatility, if the dollar weakens, it could go from helping the performance to hurting the performance. That said, its lower volatility, consistently higher returns in many different market environments, and better process, in my opinion, make LVHI the winner for me among low volatility international ETFs. Next, let's cover some of the top high dividend ETFs. International is a good place to search for dividends, since there's more of a culture of paying dividends outside the US. And tax laws favor share buybacks more in the US than most other countries. That leads to a much wider subset of companies that pay healthy dividends, even ones that also offer solid growth potential. The first one we'll cover is IDV, the iShares International Select Dividend ETF. You can find the nitty-gritty details in the prospectus, but at a high level, it basically tracks an index that includes 100 of the highest dividend-paying international developed market stocks, subject to a few criteria that attempt to find companies that have been growing their dividends and can sustain them. At 51 basis points, this is pretty expensive for a passive ETF, and its volatility has been high, as in quite a bit higher than the MSCI EFA. So despite its high yield, it may not be ideal for retirees that are trying to limit volatility. However, if all you care about is that juicy dividend yield, then this might be the option for you. The most popular international high dividend ETF is VYMI, the Vanguard International High Dividend Yield ETF. This one is cheaper at only 22 basis points and essentially invests in large, stable companies that are in roughly the top yielding half of international stocks, including emerging markets. It's had slightly lower volatility than the index, and like all the dividend strategies we'll cover, it leans toward value. So it's generally beaten the index when value has been in favor and trailed when growth has been in favor. I'd expect that to be the case most of the time for all of these dividend ETFs. In my opinion, VYMI is a solid option for a high dividend international ETF. If you're all about minimizing cost, your winner might be HDEF, the Xtrackers MSCI EFA High Dividend Yield Equity ETF, which comes in at just 9 basis points. This one is not that different from the others. It simply tracks a version of the MSCI EFA index that screens for high quality and high dividend paying companies. Another fine option. But the overall winner for me is actually LVHI again, the Franklin International Low Volatility High Dividend ETF. No, I don't work for Franklin, nor do I have any incentive to push this ETF or any others. It's just the option I would go with if I were looking for a low volatility or high income international ETF. In the high dividend category specifically, it's not the lowest cost. It's not the highest yielding, and it does have by far the highest returns, but that's not why it's the winner. It's the winner because most people who are investing for income are also in retirement. When you're relying on your investments for income, stability is every bit as important to consider as yield. More important, if you ask me. Now, that's because if you take big losses, you won't be able to sustain your income over time. It doesn't matter how high the yield is if your investment dwindles away. 1000% of zero is still zero. Mathematically, for each percentage your investment goes down, you have to make up even more than that to get back to even. If you lose 10%, you have to make about 11% to get back to even. If you lose 50%, you have to make 100% to get back to even. Since retirees generally aren't working anymore, don't have as much time to make up for big losses, and are starting out each year with a hole in their returns because of the income they're taking out, limiting losses is really important to sustaining your income over time. It's that area where LVHI has really shined over any of the other high dividend ETFs I've covered today. Let's move on to our final category, active international ETFs. And as I hinted earlier, one of these is going to be our overall winner. On the value side of the ledger, the clear winner for me would be BINV, the Brandis International ETF. Yes, it has a very short track record, but active ETFs are fairly new, and so to really evaluate them, you have to look at their sister mutual funds, which often have much longer track records. Here you can see the Brandis International Equity Fund has not only beaten the MSCI EAFE Value Index, but it's also beaten the regular MSCI EAFE Index over the last 1, 3, 5, and 10 years, which is highly impressive since it leans towards value and growth has been in favor of the last 5 and 10 years. Since inception in 1997, it's absolutely smashed the MSCI EAFE index. If you want to buy EFA, which tracks that index minus expenses, just because it's a few basis points cheaper, go for it. I won't stop you. But for me, even at 70 basis points, BINV would be a better option. Another thing that gives me confidence is that it's managed by a team of 5 people that have an average of 28 years of experience in the industry. All of them have been managing on this strategy for over 10 years, and 2 of them have been there for over 20 years. These are important things to consider when evaluating active managers because not that many people can consistently beat the market. If a fund has a great track record, but that was generated by someone who retired last year, can you really expect that to continue? And same thing, if the manager that generated that track record is still there, that's great, but do you want to have to watch it forever until they retire? That's why I prefer long tenured team managed funds. If there's a team, then one of them can retire and it's not going to completely change everything. And if they've been in place for a long time, you at least know that they're the ones who generated a lot of the track record you're looking at. Nothing is guaranteed, but in my experience, that gives you a better chance to find the active managers that can repeat their past success. Each of the next 2 ETFs I'll cover are similarly managed by long tenured teams, and BINV might be a complement to either of them since it leans toward value and they lean toward growth. The first is CGIE, the Capital Group International Equity ETF. Capital Group is one of the pioneers of international investing. They actually invented the MSCI indices, and they've been investing internationally for almost 100 years. The CI in MSCI is Capital International, which is the same company as Capital Group. Like I said, active ETFs are relatively new. So this one was launched in 2023, but its sister mutual fund, American Funds International Vantage Fund, has been around since 2011, and its underlying strategy has been available to high net worth investors since 1987. Okay, come in close here, come in close. Since 1987, it's beaten its benchmark, the MSCI EAFE, 99% of the time in all 10-year periods, by an average of about 2.5% per year, which is a lot. Like I said with BINV, if you want to go passive to save like 20 basis points per year, more power to you. But for me, I'll take my chances with a strategy that's beaten the index 99% of the time, rather than one that's beaten it less than 5% of the time, like EFA. Another impressive feature of CGIE is that it's done that mostly by taking less risk than the benchmark. Historically, it's almost always beaten the MSCI EAFE in down years, but generally lagged in huge up years. That makes sense since it was originally designed for ultra high net worth investors who had already made their money and were more interested in protecting it than taking extra risk to juice up their returns. This strategy certainly is not as low volatility as the low volatility strategies we mentioned earlier, but compared to the overall market, it has been. Unlike most equity strategies that have an objective of something like long-term growth of capital, this one aims for prudent growth of capital and conservation of principal. That's why the managers focus on companies with steady long-term growth potential and don't invest in as many value-oriented cyclical companies like BINV. And that's also why I think they could be a very good complement to each other. Both have very strong long-term track records versus the MSCI EAFE, long tenure teams in place, and repeatable processes. And as an added bonus, CGIE comes at only 54 basis points, which makes it one of the least expensive actively managed international ETFs. However, if I had to pick only one international ETF to own, it would be CGXU, Capital Group International Focus Equity ETF. It's managed by the same company as the last one we talked about, which is more dedicated than most other companies to international equities. And like the last one, the ETF is somewhat new, but it's based on a fund, American Funds Insurance Series International, that has been around since 1990. That underlying fund has beaten its benchmark 97% of the time in 10-year periods by an average of over 2.5% per year. Any of these three could have been the winner for me, but the reason why I chose CGXU, if I had to pick just one, is because I think it gives the most complete international exposure. It's the only one that includes emerging markets, and whereas BINV has historically leaned toward value and CGIE has historically leaned toward growth, CGXU tends to invest in both value and growth companies and has moved around more over time. Like CGIE, it also comes in at 54 basis points and is one of the most cost-effective active international ETFs that's managed by real people rather than an algorithm. So that's number one for me, but any of these could be number one for you. I took a lot of heat on my "Don't Just Buy VOO" video for not offering a simple alternative that works for everyone. But if you made it this far in this video, hopefully it's now clear why that's a fool's errand. Some people just prefer passive. Some people just prefer active. Some want high dividends. Some want low volatility. Some want emerging markets or small caps, and others don't. None of these approaches are inherently right or wrong, and none of them are right for everyone. What I firmly believe is important is diversification. I do not believe that VOO alone is sufficient diversification, but any of these could help you with that. So I hope this overview has helped you decide which one is right for you. In my next video, I'll be covering bond funds that can complement VOO, and I'll also be making a video on asset allocation. By the end of that, you should be well equipped to build a diversified portfolio for yourself that is tailored to your objectives. Lots of other people will just offer you a simple one-size-fits-all solution, but that may not be right for everyone. And a wise man once told me, if you give a man a fish, you feed him for a day. But if you teach a man to fish, you feed him for a lifetime. Hit that subscribe button if you want to learn how to fish. And by that, I mean truly learn how to invest, take your finances into your own hands, and build yourself and your family a better future. If you want to continue the investment conversation, check out the link below to my free Discord, and I'll see you in the next video.